Hello and welcome to this recording. In this chapter 7, we are going to discuss fixed income securities, pricing and trading. So highlights of this chapter are: most bonds and fixed income securities trade in the market on the basis of their yield or yield to maturity. So understanding what yield to maturity is very important. Changes in interest rate play an important role in pricing of bonds and fixed income securities. The fair price to pay for a bond or a fixed income security is a function of current interest rates, the term to maturity, and the coupon or income component on the security. So things that are important: interest rates impact bond. Interest rate or understanding yield to maturity is important, and the price that you pay to buy the bond, it's dependent on the coupon it pays, the interest rates in the market, the maturity time that is left on the bond, and what is the reinvestment risk that is based on coupon. So we'll discuss all of that. So little bit of time value of money. Bond price that you pay is always present value of future coupons and the maturity value. Present value of the maturity value. So it has two components: present value of future coupons and present value of the maturity amount. So what is present value? It is used to determine value of the bond. How much should be invested today to receive the face value of the security in future? So it is sum of present value of bonds cash flow that determines what you should pay for the bond today. So formula for present value is equal to future value divided by 1 plus discount rate R to the power n. So some practice problems before we get going. So what is the present value of 1040? What is the present value of 1040 to be received in 1 year's time with a 4% discount rate? So you, in your calculator, when you solve, there are 5 variables. Okay, so we'll be using calculators to solve it. So I'm starting an Excel. Okay, so 5 variables in your calculator is n per, that is n, rate, in calculator it is I by y, this is n, then there is interest, then there is PMT, PV, FV, and you can have your calculator in set end or set beginning mode. Okay, so when you solve for bond calculations, so we'll discuss bonds, then we'll come to the problem. When you solve for bond calculations, most of the bonds are generally semi-annual unless and until it is given specifically in the question that they are annual bonds. So what do you have to do by default is, whatever n is given, you have to multiply it by 2. So as n is expressed in semi-annual terms, rate also has to be expressed in semi-annual terms. So you have to divide the rate by 2 unless and until the bond is annual. It is given explicitly that the bond is annual. Next, your PMT is always mentioned as a rate, coupon rate. So coupon rate, the coupons that you get are coupon rate multiplied by face value or par value divided by 2. Again in semi-annual. Present value is what you calculate. Future value is the par value or face value, let's say 1000. And important thing is, bond calculations are always done in the end mode. So for calculating bonds, always we use end mode. Okay, so once again, whenever you're calculating questions about bond, whatever n is given, it should be multiplied by 2 unless and until the bond is annual. Rate divided by 2. Coupon rate should be PMT, you find out by coupon rate multiplied by future value divided by 2. PV you have to calculate. Face value is given, face value or par value is given. Signs are important. PMT and face value should have same signs, and by default bond calculations are done in the end mode. So coming to this problem, present value of 1040 to be received in 1 year's time with a 4% discount rate. So 1 year's time, future value is 1040. They haven't given any PMT. The PV we have to calculate. They haven't given any PMT, and the rate is 4%. So if you calculate PV, it's a rate, but since the bond is not, means it is not given to be annual or semi-annual, so we'll just consider it annual right now. N per is 1, PMT is 0, future value 1040, and type doesn't matter unless and until there is PMT. So the value of this cash flow is 1000. Present value of a 1 year bond with 1000 par value, 4% paid annually it is given with a 6% discount rate. So things that are changing: 1 year face value is 1000, coupon payment is 4% annually, so it is 4% multiplied by 1000, but it is annual, so I am not dividing it by 2, and the interest rate is now 6%. So if you go to this function, PMT is missing, so it is 40, and the face value that they have given is 1000, not 1040. So it is 981.13. Okay, value of a 1 year bond with 1000 par value, 4% coupon paid annually, and 2% discount rate. So if you just change this to 2%, the value would change. Okay, so this is the solution for it. Now this is important: 8% coupon rate, semi-annual bond, 10,000 par value, and 6% discount rate. Now this is important, and it will be 2 in this case because it's semi-annual, so 1 year has 2 semi-annual period, 2 half months period. Discount rate is 6%, so 6% divided by 2 will be our rate. Coupon rate is 8%, so it will be 4% multiplied by par value. So 4%, how did I get? So I did 8% divided by 2 multiplied by par value 10,000, so 400. PV we have to calculate. Par value is 10,000, so PV will be, rate is this, and per this, PMT this, future value this, type 0, always in end mode. So this is the answer. This is the value of the bond. Okay, so if you want, you can pause the video and try it, and then we can solve it together. So what is the present value of a semi-annual 9% 4-year bond with a par value of 100 and a 10% discount rate? So semi-annual 9% bond with a 4-year period. So 4 year means period will be 4 multiplied by 2. Coupon rate will be 9%. Divided rate of discount will be 10% divided by 2. Coupon rate will be 100 is the par, 9% is the coupon. So 9% divided by 2 multiplied by 100, and par value is 100. So if you calculate, the answer to this is 96.7. Same with this question. What is the present value of a 8% 6 years bond? So 6 years is 6 multiplied by 12. N will be 6 multiplied by 2, that is 12. The rate of discount rate is 6%. Divide by 2. So I forgot to divide by 2. Coupon rate is 8% divided by 2 multiplied by 10,000. And the par value is 10,000. So the answer is $10,995. Okay. Now in the last module we have discussed what is T-bills. So T-bills are money market instruments that are issued from discount to their par value. So they don't pay any coupon. So they are discounted for the par value when they are issued. So only gain you make is difference between par value and the price you pay to buy them. For example, let's say you buy a 180-day T-bill at 96. So what is your gain? Your gain is you have paid 96, but you're going to get 100 when it matures. So difference, that is $4, is your gain. Okay. So they pay no coupons. The interest rate is built into the price. Now the yield is annualized term. Yield is always annualized. So the yield calculation that you are seeing here is annualized. The reason why we annualize it is so that we can compare. So formula for yield is 100 minus price divided by price into 360 divided by term into 100. Price is what you pay to buy the bond. So how much are you gaining and in what duration are you making the gain? This is the explanation for the formula. Okay. For example, they have given 181 day T-bill is purchased for 98,000. Now 98,000 means everything should be brought in the multiple of 100. So 98,000 will be 98, because if 98,000 is the price you pay, so face value is 100,000. So if you just scale it in 100, it will be 900 minus 98 divided by 98. Term will be 365 divided by 181 into 100. So let's do it. So 100 equals to 100 minus 98 divided by 98 multiplied by, so I'll put brackets so that it's easier. This entire thing multiplied by 365 divided by 181 into 100. So 4.11% is the yield. The second is what is yield on a 90-day T-bill purchased for 99. So in this formula it will be 100 minus 99 divided by 99. I'm putting the brackets. Multiplied by 365 divided by, it was a 90-day bill. So the yield is 4.09. So it helps us to compare different maturity T-bills. Okay. Next is calculation for the current yield. So the current yield is a short-term measure of return. It allows investor to compare investments in bond with other short-term instruments. It is the dollar amount of coupon you are getting divided by the current market price. So there are two rates that are there. One is the coupon rate and one is the current yield. So I'm telling you the difference. Coupon rate, the formula for that is coupons that you paid divided by par value. Now current yield is different. If you see the formula for current yield, it is coupon rates, the coupon that you get divided by price that you pay to buy. Okay, so this is the difference. We divide in coupon rate by par value and we divide in price that you paid for current yield. So it is the actual interest income rate of return compared with coupon rates earned on the bond based on the prevailing bond price and the market interest rate. So current yield in different cases, you have a 10% coupon rate bond on $1,000. So how much coupon are you getting? Coupon that you are getting is 10% multiplied by 1,000, so $100. And if you purchase the bond for 1,000, for 900 and for 1,100. These are the different price combinations that are given, purchase price that are given. So in first case, the current yield will be coupon rate divided by 1,000, that is 10%. This is the current yield. Okay, in the second case it will be 100 divided by 900 and 100 divided by 1100. So the yield are 10%, 11% and 9% respectively. Important thing, sometimes 90 is given but the par value is 1,000, so you have to scale it to 900. 110 is given, so you have to scale it to 1,100. So they have calculated it. Next is YTM, the most popular. So YTM is the most popular measure of yield in bond markets. YTM shows the total return you would expect to earn over life of a bond starting today, assuming the coupons are reinvested at. So reinvestments are important. YTM calculation always assumes that the coupons that you are getting are reinvested back into the bond. It reflects the investor's return in the form of coupon income, capital gains or losses, and receiving par at maturity. The best way to solve for YTM is using a financial calculator. So we'll solve it. So calculate YTM with a 10% annual coupon, 1,000 par value and 10 years to mature. So let's do it. The bond given is annual. So what all is given? N is given, PMT is given, PV is given. PV is the price that you pay. Future value is given. You have to calculate the rate, that is YTM. So 10% annual coupon on 1000 will be, PMT will be 10% multiplied by 1000, that is $100. Please note, I'm not dividing it by 2 because it is explicitly mentioned that it is an annual coupon. If it is not mentioned, you divide it by 2. N is given to be 10 years to mature. PV is different in each case, and future value of the bond is 1000. It's a par bond, 1000. So signs are important. In the first case, PV is given to be 1000. So you are buying this bond at par, that is at 1000. So if you calculate rate of return, it would be N per PMT, PV, FV, and type of a bond is always 0. So yield is 10%. In the second case, if you purchase the bond at 90, so if you scale it in terms of 1000, it will be 900. Yield would be N per 10, PMT 100, PV 900, and FV 1000. Type is 0, so 12%. In third case, you're buying the bond for 1110, that is 1100. Please don't forget to scale it. Future value is in terms of 1000, so everything is in terms of 1000, though it is expressed as 90 and 110. So rate N per is 10, PMT is 100, PV is this sign, I'll change. Future value is 1000 and 0, but I have to change the sign for it to calculate. So 8%. So you would have noticed something with current yields as well as yield to maturity. So if bonds are bought at par, it means if, for example, face value is 1000, par value is 1000, and you buy it at 1000, then current yield equals YTM, yield to maturity, which again equals the coupon rate. So it is exactly coupon rate that what you are getting. Then if bonds are bought at discount, that is you pay $900 for a $1000 bond, then current yield and yield to maturity are greater than coupon rate. So you have to remember this function. If bonds are at discount, YTM and current yield are greater than coupon rate. if they are bought at premium, that is you pay 1100 for $1,000 bond, then current yield and YTM are less than coupon rate. The reason is, if you buy it at discount, addition to coupons, you're also going to get a capital gain. So you bought at 900, you get back 1000, so that's a capital gain. If you buy it at premium, so you'll get a capital loss. You bought at 1100 and you got back 1000, so there is a capital loss. So that's why yield is less than coupon rates in this case and yield is greater than coupon rate in this case. So this equation is important. You pause it, you note it down and remember it for the exam. So they have shown the calculations for it that we just did. So rules: if bond sells at par, coupon rate equals to YTM equals to current yield. If bond sells at discount, YTM and current yield must be greater than the coupon rate because of the capital gain. If bond trades at premium, YTM and current yield must be less than the coupon rate. Next is bond pricing properties. So bond prices move inversely to bond yields. So if interest rates or yield to maturity is going up, bond prices go down. If interest rates are coming down or YTM is coming down, the bond prices go up. Then longer the term to maturity, greater is the price fluctuation. Bonds with higher coupon move less than bonds with lower coupon. So higher coupon bonds are less sensitive than low coupon bonds. Special features leads to different pricing, like convertible bonds. Bond prices are more volatile when interest rates are low than when interest rates are high, and bonds are subject to reinvestment risk. Except zero coupon bonds. Zero coupon bonds do not have any reinvestment risk. And there is a concept of duration. So you will see this one by one. So holding maturity is constant. You can make more money with a 1% decline than you lose with 1% increase. So what does it say? Bond with higher coupon move less than bonds with lower coupon. Example, if a bond has 10% coupon rate and a bond has a 15% coupon rate, and if interest rate changes by 1%, this bond that has 10% coupon will react more. So bonds with lower coupon are more sensitive. So longer the term to maturity, the greater the price fluctuation. So the two similar bonds, one is 15 years bond, one is 25 years bond. So longer the term, more would be sensitivity. So bond B is more sensitive, so 21%. Reinvestment risk is, since the interest rate fluctuates, the interest rate prevailing at the time of purchase is unlikely to be the same as the interest rate prevailing at the time of investor reinvest cash flows from each coupon. So it means whatever coupons you are getting, you may not be able to reinvest it at the same interest rate that was there when you bought the bond. Now reinvestment risk is zero for zero coupon bonds because they don't pay any coupons. So there is no question of reinvesting. Reinvestment risk increases if the coupon payments are high. So longer the term to maturity, the less likely it is that the interest rate will remain constant over the term. The risk that coupons cannot be reinvested at the time interest rates that prevailed on the bond is called as reinvestment risk. Duration measures the sensitivity of the bond. So it combines maturity as well as it combines the coupon factors. So it means how much will the bond change for a 1% change in interest rate. Higher the duration, more risky is the bond. So it is a measure of sensitivity of a bond's price to changes in interest rate. It is the approximate percentage change in the price or value of a bond for a 1% change in interest rate. The higher the duration of the bond, the more it will react to interest rate change. So higher the duration, risky is the bond. Duration is used to determine the volatility or riskiness of the bond or the bond fund. So if what does duration mean? So if the duration is 10, then the price of bond will change by 10% if the interest rate changes by 1%. So assuming you hold a 5% coupon bond that is currently priced at 1104. So if interest rate changes by 1%, the bond will fall to 93.60. So it reacts by 10%. So the term structure of interest rates, it is the general level of interest rate at any particular time. So the level of interest rates differ according to the maturity. So different maturities have different interest rates. One thing is important, the real rate of return, it is nominal equals real plus inflation. So in recession, the real interest rate falls. In expansion, the real interest rates rise because of the changes in inflation. Now this is important, the yield curve. So what is a yield curve? So yield curve is a graph. So I'll show it to you on